Real estate investors are always looking for ways to grow the value of their portfolios and increase overall return. So it isn't surprising that one strategy that has become increasingly popular over the years has been using the cash-out refinance method to scale a real estate investment portfolio. Now, a cash-out refinance allows investors, or really any property owner, to access the equity in their existing properties to fund new purchases or renovations. So in this video, you'll learn all about what a cash-out refinance is, how investors can use it to scale their real estate portfolio, and I'll give you a concrete example of a cash out refinance that I've used on one of my properties. By the way, my name's Griffin and I've been a real estate investor for around 5 years now, having transacted over 30 rental property units and with a real estate portfolio now worth over $3.5 million in market value. And I mention this solely because when it comes to real estate, it's through actually being an investor, acquiring properties, and making mistakes really along the way that you gain experience and learn how to become a better investor. And a cash out refi is a method that I've personally used many times over, so I wanted to share with you its many benefits. Alright, so a cash out refinance is a type of mortgage refinancing that allows the borrower, you most likely, to take out a new loan on a property that they own and then want to keep for a value that exceeds the current value of the mortgage balance. The idea here is that the difference between the new loan's value and the balance owing on the initial mortgage loan can then be taken out as cash and utilized for really whatever purpose necessary if you're an investor probably purchasing another property or maybe renovating a project that you currently own. Now, just like with the original mortgage though, generally the new mortgage acquired through the cash out refinance will be secured by the borrower's property. And so this means that if the borrower is unable to make their new payments, well, the lender can foreclose on the property. This is really no different than any traditional mortgage though. Okay, now the best way to properly understand how the cash out refi works would be to visualize it with an example. I don't know about you, but for me, visualizing math always helps. So let's say you bought a property for $200,000 with a $150,000 mortgage, meaning you initially put $50,000 as a down payment. And now let's say a few years later, the property has increased in value to $250,000. And meanwhile, you've paid down your mortgage balance, of course, to let's say $120,000, right? Meaning you've built $30,000 in equity on the property by paying down the mortgage. Well, in this case, you could choose to apply for a refinancing of your property for up to 80% of the new value of the property, which in this case, 80% of the new value, $250,000, would be $200,000. That's really important to know, by the way, because when you're refinancing a property, you are always obligated to leave 20% of the building's value as equity in the property. So even if you bought the property initially with only 5% down, well, when you're going through the process of refinancing, you'll have to leave 20% of the building's new value in it as equity. Continuing on with the example though, you could then take out a new loan for $200,000, pay off your existing mortgage balance, which was at $120,000 in this example, and then theoretically you could receive $80,000 worth of cash that you can use at your discretion. This $80,000 can then be used to say purchase another rental property, fund renovations on an existing property, or if you're, let's say, in a midlife crisis, going and purchasing a new boat or motorcycle, whatever works. But that's really the basis of how a cash out refinance works. And what makes it a fantastic tool to scale a real estate portfolio over time is that the freed up capital doesn't count as taxable income. So you can utilize the entirety of it to grow your business, right? If you made $80,000 during a payday, at the personal level, you would pay a massive marginal tax rate on that income. Because this is a loan that you're taking out, it's just a new mortgage essentially. Well, that is not considered income, so you don't have to pay any tax on it. That being said, you can still use the entirety of it to go out and purchase a new property, renovations, as I just said, whatever. Now, we briefly just spoke about the refi's advantages, but there are several additional reasons why investors might choose to use a cash out refinance to scale a real estate portfolio. The first thing is that a cash out refinance allows investors to access the equity in their existing properties without having to actually sell them, right? So this means that you can access cash to fund new purchases or renovations without having to offload and wait for a property to sell, and without having to pay capital gains taxes. Basically, over time, you can maintain properties in your portfolio and leverage them further to acquire more properties. The second advantage here is that if interest rates have decreased since the investor's original mortgage, a cash out refinance could allow them to secure a lower interest rate on their new loan, which could result in lower monthly payments and overall savings. The same is true, by the way, for homeowners who bought with a high interest rate. When rates end up dropping in the future, refinancing can lower your interest rate and thus the monthly payment. By the way, I've spoken a lot about refinancing and cash out refinancing. It's basically the exact same thing, except a cash out refinance is that you would have a gap between your new mortgage loan and the old mortgage loan. The concept remains the same though. The third benefit here is that interest paid on a mortgage used to purchase or improve a rental property is going to be tax deductible. This means that investors can deduct the interest paid on their cash out refinance loan from their taxable income, because again, this new mortgage loan is a loan that will incur interest, of course, but if you're using the funds to invest with as well, not buying a boat, well, you can deduct the interest paid from your taxable income. By the way, this doesn't only apply to real estate investing. Any interest you're paying on a loan used for business or investment purposes is tax deductible. And finally, if an investor uses a refinance to purchase a new property that generates rental income, well, their total portfolio cash flow could theoretically increase, which could allow them to further invest in their portfolio or pay down other debt. That being said, refinancing at a higher property value could very well also increase the monthly payments. So while you're accessing capital upfront, your monthly running costs could also increase. So it's important to make sure that your income still covers the new expenses of the property. Now that we've covered the basics of a cash out refinancing, let's look at how investors can use it to scale their real estate portfolio. The first step in using a cash out refinance to scale your portfolio is to evaluate your existing properties. Determine the current value of each property and the amount of equity you have in each one. This will help you determine how much cash you can access through a refinancing in any given property. It's also important to consider the rental income and expenses associated with each property to ensure they are generating positive cash flow. You don't want to be in a position where you're refinancing a property, but now your property is cash flow negative a couple $100s or thousands of dollars a month. Once you've evaluated your existing properties, you should determine your overall just investment goals. Do you want to purchase more properties to increase your cash flow? Do you want to renovate your existing properties? What is the goal of your refinancing in the first place? Because taking on a new mortgage is again probably going to increase costs. So if you're doing this without a specific plan in place, it might not be the time to do so. As mentioned, I've used this method several times over the years to access the capital in my properties and scale the portfolio. But here's one example that really illustrates the power of this concept. So this was a triplex that was purchased, I believe in 2020 for $380,000 at 20% down. It had terrible income when purchased, but over the years, through tenant turnover and renovations, we were able to nearly double the monthly income. By the way, you can watch the entire video about that property right here if you're interested. That being said, roughly a year or so later, reappraised the property at $460,000, meaning a new loan of $368,000, and that is upon leaving 20% in the property as equity. Well, at that point, the initial mortgage of $304,000 was down to roughly $290,000, just to take round numbers here. So this meant a cash out amount just shy of $80,000. Now, of course, the market conditions definitely helped and tenant turnover helped as well, but regardless, the concept is very powerful. Keep in mind, this did, however, increase the monthly mortgage cost, but the income was large enough in this case to fully cover all of the property's expenses. If you want to learn more about real estate investing, I highly encourage you to check out all of the free content I have in my real estate investing playlist right here on YouTube. And if you want to take things one step further, check out my full real estate investing course over on Udemy. It's going to cover everything you need to know, all of the major steps necessary for analyzing and acquiring your first rental property and using strategies to scale. Hope you enjoyed today's video. If you did, please take a second, drop a like, subscribe to the channel, and I'll see you in the next one.